Today, we're going to reflect on what billionaire investor Chamath Palihapitiya had to say about the disconnect between the US economy and the stock market. Welcome back, everyone. This is the first video of a series that covers some real interesting takes coming from one of my favorite people to listen to when it comes to talking about the state of the economy, investing, and how to approach looking at businesses during these uncertain times. If you don't know Chamath, he is the CEO of Social Capital, chairman of Virgin Galactic, which is a commercial spacecraft company, and he also owns the Golden State Warriors. He was the youngest VP at AOL back in the day, and later on became an executive at Facebook, who was a big part of growing Facebook early on that later led to them achieving 1 billion monthly active users and being worth hundreds of billions of dollars. I'm not sure if it's because he's doing more interviews now, but I have noticed that in the last few months, Chamath has become a little more popular. More and more people are finding out about him and quickly get drawn to him because he is truly a great mind. He's very rational and is a great speaker. He really measures his words and is very good at articulating himself without sounding too sophisticated, while at the same time not dumbing it down too much. And obviously, most importantly, in my opinion at least, he has very good investing insight, and I really enjoy as well as have learned a lot from his views on the world as well as how effective businesses are supposed to be run. So, back to the topic. It's obvious that the US stock market is not a representation of the economy at the moment. It's actually a representation of central bank actions. What we've seen over the last 2 months is unemployment, GDP, company earnings, everything is going down. All of the economic data is going negative. But the stock market is rallying. So there's this dislocation between sort of the economic carnage on the ground and what stock investors are seeing. All this money printing from the Federal Reserve is definitely inflating stock prices right now, and it doesn't look like they're going to slow down anytime soon, which makes me really worried because that's not really good for the long-term health of our economy. Let's take a look at what Chamath had to say about this.
Chamath, it's great to see you this morning. I think where I want to start is the big news of today and what's become a debate, the Fed planning to buy up ETFs backed by bonds, and what that means, and what do you think it says about our economy, and what kind of debate you think there's going to be in this country about the steps the government's taking?
Well, I think that if there was any doubt before, there should be no doubt now that we have completely divorced the economy from the stock and the bond markets. And the Fed has been the principal agent of that obfuscation. And so, what these guys are doing now is, with the ballooning balance sheet and all of this money going into prop up companies, what you're going to start is you're going to accelerate a really bad deflationary super cycle here. So, if you think about this, Andrew, like the best technology companies in the world have literally been training billions of consumers to not really spend money, right? The whole idea is, if you wait, tomorrow you'll get more for less. Whether that's YouTube or Facebook or Google or Amazon, the point is that these guys have really conditioned people that, you on balance want to actually not be spending that much money because we'll just be giving you more and more value. And when you, on top of that, then add to the fact that the Fed comes and pumps in all of this money that has to go someplace, consumers respond by picking these companies that give them more for less. That's where all the profits get trapped. As a result, a handful of companies really disproportionately perform and inflate the equity markets. The companies that actually traffic in traditional business models that don't necessarily have tech at their disposal get decimated. And so that cycle is just going to get exacerbated and exacerbated. So in the real world, things will continue to get cheaper for the future. Now,
that's a very interesting point, but what do we do? What is the right way to allocate stimulus money so that it is proportionally spent or used throughout our economy? Honestly, in my opinion, I think this is an impossible task for anyone, but especially for our politicians. They are being asked to come up with a highly complex solution to a highly complex problem that has so many variables, but to also do it while hundreds of millions of people are watching. Not to mention that they have to come up with a solution on a frantic timeline because so many people need help immediately. Let's see what Chamath had to say when asked about this.
Chamath, though, here's the question. And I'm not advocating the Fed doesn't do these things because I don't think that there's many other options The problem is that it's a blunt instrument to a large degree. And while you'd love to make the stimulus, if you will, more effective or get it to the right people, we don't have a system of government that necessarily is, at least can or is willing to do that.
Well, we have to figure out how to break this cycle of deflation. And when we're a debtor, when you are a debtor, the best thing for you is some form of inflation, or at least to minimize the effects of deflation. And the reality is that we do have a system, and you don't have to pick who the quote unquote right people are. The right people is every citizen of the United States. And I've said this before, but this is a point in time where direct fiscal stimulus should be going to the hands of US taxpayers. It is the most effective way to blunt this unnecessarily rampant asset inflation in the markets, and at least balance it with incentives in the hands of consumers to buy things. And if you don't break this cycle and teach a new pattern of behavior, we're going to be looking at a Japanese-style deflationary period where we'll have 10 years of unemployment, the economy will just be stagnant, and we'll wonder why equity markets keep going to all-time highs when it doesn't actually map to what you see in the real world on a day-to-day basis. I would say that 90% of the gains actually happened when the Fed just signaled that they were going to do something. You're absolutely right. It calmed the markets down enough where the best companies could go and actually get the capital that they needed. But then if you actually separate it and look at it now, the Fed's primary and secondary facilities aren't necessarily going to affect or help the best companies, because in order to sort of qualify for these programs, you need to go through a whole bunch of hoops. You need to sign up for supervision on executive compensation. You are going to self-select, at least in their primary facility, for probably the worst performing companies. And when you go and buy ETFs, you're buying baskets of things that also contain a bunch of these zombie companies. The best companies can and will continue to self-finance in the markets by themselves. And yeah, you're right, the Fed did calm the waters. But by now actually stepping in and spending more and injecting more capital, what you're going to see is the equity markets rip higher. You're going to see the credit markets continue to basically go towards negative rates. And none of that stuff does anything to actually fix the economy. And so asset inflation, we learned this from 2008 to now. Asset inflation does not solve income disparity. It actually doesn't solve full employment. It doesn't do any of the things we needed to do for it to be a robust economy. What it does is allow people who play in the financial markets to make money. Those don't trickle down to normal people. And until we actually admit that to ourselves, and until we realize that this dogmatic idea that inflation is bad, that's a dated idea, we're not going to move forward. And so I appreciate the fact that the Fed did something. I think it was critical. I think it was great that they said it. But now actually acting and pumping in all of this money on top of the money that's already gone in is creating a deflationary supercycle in the United States that is not helpful. Consumers are not going to spend. They are going to save.
Those are some powerful words from Chamath. As soon as the Fed signals that they're going to do something, the markets shoot up, even though everything else is going negative. This is literally the worst possible outcome because, as Chamath mentioned, asset inflation does not solve income disparity. It does not get us closer to full employment. It does not give the average consumer confidence to go out there and start spending again at the same rate, which is what drives our economy and millions of US businesses. So I'm hoping that moving forward, our government realizes this and really starts to trust what some of the great minds of today are saying. And I think they will. I think eventually they will get it right. And at some point after that, the US economy and the stock market will regress back to being aligned and moving in tandem again. There has to be either the stock market coming down to meet the reality of the situation that we're in, or the reality of the economy has to improve to meet those high expectations that we're seeing in stocks right now. But there's definitely a disconnect at the moment that's being driven by our central bank. So I know there's a lot of people out there that are wondering how long this economic downturn is going to last. What time frame are we putting, and how long is everything going to take to recover? I think we have a long way to go, in my opinion. First of all, the economy is not going to recover with everyone sitting at home, right? So Before anything else, we have to figure out how to get people back to work safely and get them spending money again and consuming. But this is a tall task because so many things haven't fully played out yet. Things that are difficult to measure, like how certain businesses or event-driven businesses like concerts, stadiums, theaters are going to open up with social distancing, what their revenue is going to look like, if they're going to change prices or not, the willingness of people to get back out there and enjoy these highly social, crowded areas where you are essentially having all these anonymous interactions with people that you don't really know. Also, let's think about what's happening with so many of these businesses. I don't think that as a business you can shut down, tell all of your employees to go home, tell your customers that you're closed down, and then one day on a random day open back up and expect to have all of your employees and all of your customers running through your door again. I mean, it takes time to do that. What do they say? It takes about 30 days to form a new habit. Well, currently, right now at the moment, everyone is forming new habits of spending money and saving money because they just don't know what's going to happen or if we're going to get a second wave or whatnot. That is it for this video, guys. Thank you so much for watching. Look out for the next video in my Chamath Palihapitiya series. And if you enjoyed this video, please hit the like button, subscribe to my channel if you haven't yet, and let me know what you think about Chamath in the comment section. Thank you.